Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Asian stocks rally after Fed Chair Jay Powell signals an interest rate cut could come as soon as next month, despite divisions amongst policymakers over challenges in inflation and the jobs market. Intel Investment. The U.S. government takes a near 10% stake worth $8.9 billion in a bid to reinvigorate the beleaguered company and boost domestic chipmaking. And earnings ahead, African miners and telcos are in the spotlight as we take a look at some of the companies releasing results this week. Well, it has just gone 8 a.m. across the Emirates. I'm Jumana Versace, back in Dubai after 2 weeks off. It feels like a lot more than that, let me tell you. But the news gods have delivered. We've got a lot to talk about today, especially after that Jay Powell speech at Jackson Hole on Friday. It really was a major catalyst for markets. We've moved to pricing almost with certainty a September interest rate cut. It's about 84% priced in now if you look up what the markets are implying. And of course, that turbocharged stocks on Friday. We saw a big bounce for the S&P up 1.5%, NASDAQ up 1.8% on Friday, and the Dow reaching an all-time high. So very strong session. Also a major rally in the front end of the curve because of the repricing of interest rate expectations. Today, though, what you are seeing is stabilization, consolidation. U.S. futures not doing a whole lot, inching towards the red. Remember, it's also a very big week in terms of further auctions coming up. We've got 2-year, 5-year, 7-year auctions. You've got PCE inflation data to watch out for. And the big one on the earnings front, we've got NVIDIA earnings, the darling stock of, the world, I would say, not just U.S. stock markets, that is reporting this week too. So keep an eye out on NVIDIA earnings. USD, as you can see here, also up about 6 basis points this morning. Though after that Jackson Hole speech on Friday, you did see the dollar slip quite a lot, down about 0.5%. Okay, let's move on and check in on how markets in Asia are faring as well. David Ingles is in Hong Kong. David, really good to have you with us on the show. Lots of green on the screen this morning. How do we explain that?
Yeah, well, a ton. Well, there are two things. One is, to your point, and welcome back, by the way, and one thing that's changed since you went away 2 weeks back, and it's really a market that's rallied 3% on a benchmark basis, and that now puts us within 3% of that fresh record. So one thing is, of course, Jay Powell and him opening the door, of course, to rate cuts. That's really lifting, I think, in many ways, leading to a weaker dollar in the Asia Pacific. The other thing as well is coming through from the PBOC today, setting the fixing of the currency. Strongest adjustment going back to January. And as you can see, that's really leading to a steep decline in the dollar. That's leading into inflows in the region. And what you're really seeing in the equity market itself, so on top of all those things, this rally is extending in Chinese markets, right? So we're on the break right now in Hong Kong. 2 trillion in the morning session alone in the onshore market. Point number one. Point number two, and we now understand why we are getting a massive move in Chinese markets. It's the breaking news right now that Shanghai has now eased home buying curbs from the 26th of August, which, okay, I'm losing track of time, which is effective tomorrow. So we now understand why things are looking the way they look. Jumana, back to you.
Yeah, that turnover number is really impressive. 2 trillion on the session, I guess, as you say, in anticipation of some of those measures that seem to be coming through now. So keeping a close eye on some of the stimulus coming through from China. David Ingles in Hong Kong, thank you so much. Right, let's go back to our main story. Chair Jerome Powell, the Fed Chair Jerome Powell, has signaled that the Fed is headed for rate cuts as soon as September. But he also noted the economy has handed the central bank a challenging situation.
The baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Our policy rate is restrictive, modestly so in my view. The stability of the unemployment rate and other labor market measures allows us to proceed carefully. While the labor market appears to be in balance, it is a curious kind of balance. Longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored. We will not allow a one-time increase in the price level to become an ongoing inflation problem.
All right, let's talk more about this with Bloomberg MLife strategist Mary Nicola, who joins us for more. Mary, good to have you with us. The main line that people seem to be squaring in on is this one. The baseline outlook and shifting balance of risks may warrant adjusting our policy stance. So the market has taken that to believe that September is now a live meeting.
Yeah, absolutely. And that's what markets have gotten really excited about, is the fact that he's opened the door to a September rate cut. You know, last week, it was more or less that the focus was on whether he pushes back on expectations of Fed rate cuts. That clearly wasn't the case. Yes, he opened the door for a September rate cut. I think he, especially with the focus on the labor market, he sets the bar a lot higher. So in case if, let's say, sets the bar a lot higher in terms of keeping rates steady, which in some cases would suggest that unless PCE comes really hot or we see an adjustment in the labor market, it looks like the Fed is going to proceed. However, I think one of the key things to highlight is that he still had a little bit of a cautious tone, which would suggest that it's not free and clear of where the policy rates are headed, or are we in the start of an aggressive rate cutting cycle. So I think there is where he's set the tone for an opening, but not for a forge ahead on the easing cycle.
Mary, in light of what we learned and what we heard from the Fed chair on Friday, how significant is the PCE data going to be this week in terms of the Fed's imminent decision making? Or perhaps it's going to have more bearings on whether this actually turns into a full-blown rate cutting cycle?
Yeah, I think for the PCE data, it really has to come in exceptionally hot for the Fed to really change its mind, or for some sort of suggestion to say that inflation is becoming a very big problem. And of course, it has to coincide with, let's say, a really hot labor market for, you know, when we get the payrolls later on in September. So I think it needs to show that overall, I think their focus still is on the labor market. But if we see an exceptionally hot PCE number, that's going to change the bar and change the risks for the central bank. But overall, I think what we will see is that September is going to remain in place in terms of expectations, but it's just what happens thereafter is going to, I think the markets are going to still take a cautious tone, and I think the Fed is going to still take a cautious tone, especially if we get a faster pace in PCE.
Yeah. Okay. Bloomberg's MLife strategist, Mary Nicola, thank you so much. Let's pick up the conversation even further. Joining us now is Sonali Rawal, international business head at Anand Rathi Wealth. Really good to have you with us. So, in your mind, is September a done deal now for a cut?
It seems like it. And also, if you look at, you know, the unemployment data at 4.2% and the inflation at 2.7%, there is a dichotomy that the Fed has. Yeah. And you haven't seen any kind of rate changes since January. If you are looking the underlying information of the 4.2% of unemployment, there isn't that much job growth. And there aren't that many people that are looking out for jobs. So that is what is concerning. And it's very valid for Powell to be doing this and consider the rate cut. That boost of economy which is really needed, or that boost of sentiment that is needed to kind of address this first. Yeah. Inflation is important, yes, but it's actually going to play out with tariffs coming in, and that is a bigger problem that has to be dealt with a little bit later.
And yet the focus is going to shift away from September towards whether this really is the beginning of a sustained rate-cutting cycle. And you could argue that rates are still somewhat restrictive now.
Yes.
So will they have to bring them down quickly to a point where it's actually stimulative for the economy?
It again depends a lot on what the tariff situation plays out and how the inflation numbers are going to go out. You know, but at this point in time, you have to really weigh out what's going to be the more important thing is to look at looking at that unemployment data and getting that sentiment changed.
How do you see the U.S. data transpiring in the next couple of months? Because even in that speech, the Fed Chair Jay Powell referred to some of the weakness that's beginning to show up in the labor market. Yes. How bad are things going to get in the next few months?
See, I really think that it's not just about the data that is showing, but also there is expectation of inflation. There's a lot of uncertainty that's going on the ground. You know, people are going to be delaying consumption if you have that inflation is going to come in. They are expecting that there are going to be job cuts. A lot of that is going to play out as well. So the situation might end end up being worse than what is anticipated. Also, a lot depends on what plays out. The uncertainty seems to be what is, not letting you go one way or another. So some amount of action on one front is going to help the sentiment.
I guess what I'm trying to figure out is whether we're on track for a slowdown of the U.S. economy or a recession in the U.S. economy.
So I think we've talked about this earlier as well. In terms of recession, I think the U.S. economy is quite resilient. If you do see, yes, we saw, a smaller growth in the GDP in the first quarter, but then the second quarter was better. And then again, we're anticipating what are going to be the numbers, next week, which are going to come out for the GDP. And that's going to help us to see what direction it's going into. I think the recession risks still stay low. However, there are some really big problems that the U.S. need to address, unemployment staying one of them. And then, of course, the mounting debt that they have, inflationary pressures. Inflation still stays at a very high number. 2.7% is still much higher than the target of 2%. So, we still have a long way to go.
Yeah, and yet U.S. equities continue to roar back. We've got Dow making an all-time record high. You've got, strong performance at S&P, NASDAQ.
Absolutely.
That continues.
That continues. And that's what it is. Like it's I think, similar to what we were talking about earlier about China as well. The economic data doesn't necessarily warrant the kind of movement in the markets. But then, you have these markets that are going on about it because of the fact that that this is a problem that you're going to have to wait and watch. So you do have long-term investors that are wanting to get in as well and the traders who are wanting to clock gains for their investors.
There's another big event coming up this week, and that is the additional 25% tariffs that the U.S. is going to impose on India because of their purchases of Russian oil, or at least that's the reason, the justification that Trump is giving.
Yes.
How damaging is this going to be for India?
So if you actually look at it for India, the total exports that India does to the U.S., U.S. is its largest export market, about $81 billion, right? Some amount of goods are exempt from these tariffs, like the pharmaceuticals and, smartphones, etc. So that is about $15 billion, which is going to be exempt. So if you look at this $81 billion, $65 billion that we have, if the 25% is going to come in, which is most likely going to come in because there were supposed to be talks between, them between 25th and 29th, which is, in the public domain, it is saying that, they're not coming. The U.S. officials are not going to be coming to India anymore. However, External Affairs Minister has said that there are ongoing talks, but assuming this is going to come in, it is going to be completely unviable to be exporting at that 50% tariff, right? So what India has to do is try and find, for the $65 billion, other trade partners. Prime Minister Modi has been, looking for other trade partners along these months. We have signed some agreements. There are a lot of negotiations that are going on. And assuming that 40% we're able to find alternatives, we're talking about $40 billion that would be a trade loss. That's still about 1% of India's GDP of about $4.2 trillion. So it's not a very big impact.
Yeah.
The other big thing as well is that even if you look at it from the GDP growth, we're currently at about 6.6, 6.7% or so.
It's still a fast-growing economy.
Yes, so even if we bring it down, it's not going to make a significant dent.
Yeah, good to have that framing. Sonali, really good to have you with us on the show. Thank you so much.
Thank you.
Sonali Rawal, International Business Head at Anand Rathi Wealth. Now, central bankers at the Fed Symposium in Jackson Hole expressed support for Jay Powell amid President Trump's relentless attacks on him over interest rates. Powell got a standing ovation before his speech, with officials stressing in media interviews the importance of central bank independence.
In my IMF days, I have seen close hand what happens when a central bank stops being independent or when its independence is under threat. It becomes dysfunctional, it starts doing things that it shouldn't do, and the next step it is disruption, it is instability, if not worse. So I think that it should not be debated.
Absolutely critical, the independence of the Fed. That does not mean the Fed is not held accountable. I think this is important. Independence doesn't mean you get to do whatever you want to do. There is still an accountability. There's an accountability to Congress. And there's an accountability to the markets, right? There's an accountability to the American people more generally. So I think you can't lose sight of that.
Well, still ahead, President Trump strikes an unprecedented deal with Intel, giving the U.S. government a nearly 10% stake in the chipmaker. The latest in the tech space next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. The U.S. government is taking a 10% stake in Intel as part of an unconventional bid to revive the company and boost domestic chip manufacturing.
You know what? I think the United States should be given 10% of Intel. And he said, I would consider that. I said, well, I'd like you to do that because Intel has been left behind.
I'm so sorry. I'm quite distracted by his cap there. Trump was right about everything, is what his cap said.
Well.
Let's bring in our Asia Tech correspondent, Annabelle Jewelers in Hong Kong. Okay, let's move away from the cap and talk about the actual deal. The fact that the U.S. government is taking almost 10% stake in Intel. How is this going to help turn the company's fortunes around?
That's certainly the hope. I mean, it's certainly unconventional, and we can get to that maybe in a moment. But the sort of broader shape that the deal is taking here, so the U.S. government is essentially buying up 433 million shares of common stock. That is just under a 10% stake in the business, as you said, and the deal itself was worth around $11.1 billion. So that really was the money that it was going to be receiving under the U.S. Chips and Science Act. Some of it already received around $2 billion worth, and the rest was to come. So pretty much the terms of the deal that we've been reporting over the past few days. The government, though, is actually going to be a passive owner in the company, so no board seat or other governance or information rights. So to your point around how it could help turn it around, I mean, we certainly have seen a bit of a change of tune in Intel's stock performance, for instance, but you're still at the outset of what's going to be perhaps a multi-year restructuring effort. What is clear, though, is that the U.S. government actually doing this is very unconventional. You don't typically see the U.S. government taking a stake in any businesses, not least like one that's a 10% stake. And so that sort of abnormality also underscores the significance of why the U.S. government wants to do that, and that is to build up the U.S. manufacturing of semiconductors.
Yeah, a shift towards, state capitalism in this case, more interventionism in companies. Speaking of important companies, we've got major earnings coming out this week from NVIDIA. So, what should we be watching out for from what is probably the most or one of the most important stocks to follow this week?
I think you can probably have that the most going to be the most tracked company this week, really. I mean, it makes up around 3% of the global market cap. It's the heaviest weighting on the S&P 500 as well, at around 8%. It's going to be really important to track because you have seen tech stocks a little bit under pressure of late. Concerns resurfacing once again around the health of the AI-led rally, whether that should be sustained moving forward. Here you're taking a look at some of those numbers we're expecting. So revenue, for instance, expected to come in at $46 billion for the period. That would be around a 50% jump in revenue on the year. Adjusted earnings per share of just over $1 US as well. Options traders are certainly saying you're going to be seeing big swings in either direction, around 6% plus or minus post the numbers. But one of the big questions as well for analysts going into this is what is NVIDIA going to be saying about China? Because last week, one of the big stories was how, yes, the US has reversed its decision to halt sales of H20 chip to China. But now you're hearing the Chinese government is also encouraging firms not to buy up that chip that was specifically designed for the mainland market. So now exactly what does NVIDIA do about this question mark, given we're hearing they've also halted production of that chip as well, and they continue to have reliance on the mainland market as well.
Yeah, so still very much caught in the crosshairs of the geopolitical tensions between the U.S. and China. Asia Tech correspondent Annabelle Jewelers, always a pleasure. Thank you so much. Coming up, miners and telcos. We get the details of what to watch out for with African earnings this week. That's next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Shimona Versace in Dubai. Well, former St. Louis Fed President James Bullard says he thinks there is a case for 100 basis points worth of rate cuts before next year. Bullard is a contender to succeed Jay Powell as Fed Chair and spoke to us after Powell's comments at Jackson Hole, putting a September cut on the table.
He used the speech to solidify expectations for 25 basis points in September. I was expecting that anyway. Markets were expecting that. He leaned into the most recent labor market report, which was very soft. And so I think that's a done deal. He didn't say too much about beyond that, what you want to do with the October meeting or the December meeting. I have said 100 basis points, going into 2026. So I think you could adjust as you go forward and eventually get a full 100 basis points, but I would go slowly in order to watch the data. And then on the framework review, I'm sure much earlier in the year, they had targeted that they would have the framework discussion and that they would use the Jackson Hole speech to talk about changes to the framework. I thought those were thoughtful and they were well presented in this speech, and they're about what many have speculated on. So I think they did about as much as they can on the framework side.
Jim Bullard, Tom Keenan, good morning to you. I definitely consider this my conversation of the day. You served a lengthy term at the St. Louis Fed. You have lived the decline of a greater economy decades and decades ago in the effort to provide for a resurgent St. Louis. As the next chairman of the Fed, whoever that may be, do they have to manage for two American economies, a technology-driven, exceptional economy, and another, to use a cliche, America flat on their back? How would a chairman execute those two Americas?
Yeah, I think income and wealth distribution have become more salient topics for the Fed. It's not that clear how much the Fed can really do. Providing interest rate policy for the whole economy. If you change the rate structure, that affects everyone, not just one particular group that you might be targeting. So I think that's been something we've had to wrestle with, and I've actually done research on it myself to try to understand it better from my point of view. So I think this has been a theme for a while, and that'll be an important theme in macroeconomics going forward.
That was former St. Louis Fed President James Bullard speaking to Bloomberg's Tom Keane. And coming up, Saudi Arabia and the Olympic Council of Asia are in talks to move the 2029 Asian Winter Games. We'll find out more next. This is Bloomberg. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Asian stocks rally after Fed Chair Jay Powell signals an interest rate cut could come as soon as next month, despite divisions amongst policymakers over challenges in inflation and the jobs market. Intel Investment, the U.S. government takes a near 10% stake worth $8.9 billion in a bid to reinvigorate the beleaguered company and boost domestic chipmaking. And Saudi Arabia's winter dreams on thin ice. Riyadh and Asia's Olympic Council look to alternatives for 2029's planned Asian Winter Games amid construction challenges. It's just gone 8:30 a.m. across the Emirates. I'm Shimona Versace in Dubai. While markets on Friday had a very strong reaction to the Fed Chair Jerome Powell's speech at Jackson Hole, laying the groundwork for a potential September cut, sounded quite dovish, especially on the outlook for the labor market. What you got was a big rally in the S&P and NASDAQ. Both soared more than 1.5% in trading. Massive rally in the front end as well. Two-year yields were down about 10 basis points throughout the course of trade. Today, some stabilization coming through. As you can see, markets trading sideways, but of course, NVIDIA earnings going to be key to watch later this week. And of course, PCE data alongside 2-year, 5-year, 7-year auctions too to watch out for interest rate space. And then keep an eye on the USD as well. Interesting price action on Friday in that we sold off about 0.5% for the greenback after that quite dovish speech. Today, we're up 6 basis points, but the point is the dollar can't seem to be getting a sustained bid at this point. So this is the picture for markets today. But let's move on and check in on how markets in Asia are faring. David Inglis is in Hong Kong. And David, earlier we were talking about some of these new easing of home buying curbs that have been announced out of Shanghai. Has that been a major catalyst for some of the green that we're seeing in the markets this morning?
I mean, it certainly has. I think what's interesting about that specific news line that came through is that, in the morning session, before the news actually came, we already saw limit up moves in some of the big property names, and we were trying to figure out what it was. Could it be earnings, which weren't very, very good? But perhaps now we understand maybe more context there of expectations that more support was coming, and then things, of course, then came. So in the morning session, in about 30 minutes' time, we'll get in the afternoon session up and running. So we are actually on track for likely, and possibly, of course, we'll see how the afternoon session pans out, for an all-time high as far as turnover is concerned. Right now, the question is, are we looking at any short-term signs of overheating in this market? And case in point, Shanghai Composite actually is now a top 5 benchmark globally this month. And, some of the metrics, RSI 70, of course, is that typical threshold. We're at 87 now. Stochastics 80 is that threshold. We're at 94. We're also above the upper Bollinger Band. So yes is the answer to the question, but the market can remain overheated for a long time, especially given momentum liquidity. One last note, though, that I'll bring up here. A lot of people talk about margin debt, right? Leverage, speculation in the economy. You have to correct that with turnover, is the point from Morgan Stanley. So when you take the ratio of that, while margin debt is at a 10-year high, the ratio is actually quite near lows, even going back about 10 years. I think it's something to keep in mind as we try and figure out what's noise from signal as it pertains to overheating signs in this market.
Yeah, you've got to love a David Inglis market wrap. It isn't that often that we hear about stochastics and RSI, but there you go. David Inglis for you, everybody, in Hong Kong. All right, closer to home, Saudi Arabia and the Olympic Council of Asia are in talks with China and South Korea about potentially moving the 2029 Asian Winter Games. It comes as Saudi Arabia faces construction challenges with its planned ski resorts. Now, joining us now is Tim Callen, visiting fellow at the Arab Gulf States Institute. Well, my colleagues Abir, Zainab, and Christine put this story together last Friday, talking about Saudi Arabia potentially looking for another host for the 2029 Winter Olympics because of some construction delays. Let me just start off by asking you, if that actually does happen, how damaging would it be for Saudi Arabia and its global reputation?
Yeah, I mean, good morning. Well, look, I think it's clearly not great for the global reputation if, in the end, the Winter Games need to be moved. Of course, at this stage, that's not clear what the end outcome will be. But it's certainly going to be better to do it sooner rather than later if that is going to be the outcome. And I don't think ultimately that moving the Winter Games will have a big impact on either the Vision 2030 program more broadly going forward, or even on other global and regional events that the Kingdom's going to be hosting, such as the World Cup or the 2030 Expo. Hosting those is going to be challenging. It'll require a lot of infrastructure development, but I don't think either of them are going to be as technically challenging as the Trojana resort, which is the basis of the Asian Winter Games. Yeah.
It was always going to be a very ambitious project, starting out with, hosting Winter Games, creating the snow that's necessary. Is there an argument that perhaps international investors may actually respond well to this, and that it shows that Saudi Arabia are being a lot more pragmatic and rational about the types of projects that they can undertake and the time frame in which they can undertake those projects?
Yeah, I think that that's a valid argument. Look, I mean, I think there's been doubt for a while about whether the scale and ambition of many of the Saudi giga projects is is realistic, and I think it's also fair to point out that I don't think the economy, in terms of the overall desire to grow the economy, diversify the economy, necessarily needs the biggest and best projects to do that. Having some successes, developing more entertainment options, more tourism options, more alternate energy that are the basis of some of these projects. If you can do that to some extent, it can help hugely, I think, with the growth and diversification ambitions. And I think investors would actually respond positively if the government comes out, plans for some scaling back of these projects and is then transparent going forward about what the scale and the cost of the projects are. Investors can then work out better, right, what rate of returns will be.
Yeah. So in which parts of the economy or which sectors specifically are you expecting further recalibration to occur?
Well, I think one that's been in the news is clearly the line, and maybe more broadly other parts of NEOM as well, which is clearly the most expensive and in many ways also technically I think very challenging there. I think doing reviews of other giga projects would also be helpful to the authorities. It's undoubtedly true, right, that we're sitting on a smaller pot of money for the government now than was the case in 2022. Oil prices are below 70 rather than around $100 a barrel. So I think looking at these projects, seeing what is financially doable, what is technically doable, and whether the assumptions that were first put out underlying these projects still hold, that would make a lot of sense, and that's going to help come out with the right outcomes for the Saudi economy going forward.
Yeah, Tim, so much of the discourse has been about what the Saudi Arabian government is doing to recalibrate or reprioritize spending. What about the PIF? The annual report came out last week. You penned very interesting analysis on some of the takeaways from that report, and two of your findings jumped out to me. Number one, AUM grew, but only because of the passage of that Aramco dividend to PIF. And the second is that if you infer what the rate of return was for last year, essentially it was flatlining. So it seems as though there are some clear headwinds facing the PIF as well from this point onwards.
Yeah, I think that's right. So we know that the PIF received a rather large chunk of Aramco equity from the government in the early part of last year. That, according to my calculations, accounted for almost all of the asset growth that the PIF recorded last year. And in rates of return, I mean, the rates of return the PIF has enjoyed up until 2024 were pretty robust, right? Average annual rates of 8.5% to 9%, but at least from what I can calculate from the available information, the rate of return was close to zero last year. Of course, part of that is the Saudi stock market, of which many of the PIF's assets held, didn't perform particularly well last year. But also, it looks like there have been write-downs on some of the giga projects, as the PIF calls them. How, what extent, the reasons exactly where, we don't know. That information hasn't been made publicly available, but that is what you can glean from the information published in the report. Yeah.
Really interesting analysis you penned there. It's up on your LinkedIn for anyone who's interested. Tim Callen, thank you so much for joining us, visiting fellow at the Arab Gulf States Institute. Well, another story we're watching this morning. HSBC's Swiss private bank is said to be ending relationships with wealthy clients from the Middle East, including many with assets exceeding $100 million. Sources tell Bloomberg over 1,000 clients from Saudi Arabia, Lebanon, Qatar, and Egypt will be affected. The move comes as the bank seeks to lower its exposure to individuals it considers high risk. And for more of these stories looking into the intersection of wealth and power in the region, sign up for our Mideast Money newsletter on Bloomberg.com. Now, despite their label as ethical investments, ESG-labeled funds are increasingly putting money into the deadliest weapons ever manufactured. Since Russia's full-scale invasion of Ukraine, funds exposed to nuclear weapons companies have soared more than 50%. Let's talk to David Stringer, Bloomberg's managing editor for climate and ESG. I've got to say, it's pretty surprising to hear that nuclear weapons are now being included as part of the ESG portfolio construction. How widespread is this pivot to defense and nuclear weapons?
Hi, morning. Well, I think you've captured it right there. I mean, it is really surprising, but what we're seeing is a very clear dynamic in Europe's nearly 9 trillion ESG fund sector. As you said, since that Russia's invasion of Ukraine in early 2022, what we've seen is that ESG equity funds, their exposure to the nuclear arms sector has increased more than 50% to about upwards of 2,000 funds now having some exposure to that sector. What that means, in effect, is that half of all of Europe's ESG funds now have holdings of either companies that manufacture, that transport or supply nuclear weapons. So, a really marked shift. And what we're hearing from money managers is, it's part of a rationale of the defense of democracy. They're really focused on this as, when it comes to ESG, part of the S, part of that social mandate, and argue that channeling money into defense, into weapons manufacturing, can be ESG compliant.
Yeah, I mean, it sounds a bit paradoxical, but again, the industry has come under so much scrutiny over the last couple of years. First, you had greenwashing, then you had the pivot from the Trump administration, the backlash against the energy transition. What is this pivot into the defense industry? Tell us about the evolution of ESG investing as an asset class.
Quite. I mean, it really shows that this is an industry, this is an asset class that's in a kind of a moment of inflection. As you said, ESG investing has been under attack from many sides. We've seen in recent months, we've seen record outflows from funds, and that's not only because of those political attacks that we've seen from the US, but also because of really lackluster returns. Also because, we're seeing a bit of regulatory fatigue too. So the whole concept of ESG, has been a little in flux, and that's really crystallized in this debate. On the one hand, money managers and funds that argue expanding the framework to include sectors like defense is logical and sort of sits and adheres to the overarching principles. And then quite clearly, on the other side, critics who say this is absolute anathema and that ESG funds should have nothing to do with weapons of mass destruction. I think it really shows a sector that is in flux, and really people who are thinking, what actually does ESG mean as a concept?
Yeah, well, it's become an existential question. Anyone looking for more information, you can read it all on today's Big Take. David Stringer, Bloomberg's managing editor for climate and ESG, thanks so much for joining. Well, coming up, miners and telcos. We get the details of what to watch out for with African earnings this week. That's next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. It's another big week for African companies reporting, with miners and telcos in the spotlight. Last week, investors flocked to DRD Gold after it doubled its annual dividend, and Goldfield's first half profit jumped on soaring gold prices. For more on what's on the docket this week, our Chief Africa correspondent Jennifer Zabajaja joins us now. Jen, maybe let's just start with the miners, especially given some of the moves in some of those gold-related stocks last week. What are we watching out for this week?
Right. Good morning, Jumana. I think we should just take a step back and see and look at some of those miners you were just mentioning there, because as you were mentioning, Goldfield's profit more than doubled. DRD Gold is an interesting story, especially if you look at what they were forecasting not too long ago for investors. They were suggesting that potentially they were going to miss their production for this year. Now they're actually saying that the expectation was, or what they actually ended up reporting, a 3% slip in sales, but that was offset by a 31% jump considering the gold prices, as you were just mentioning there. Now, if we take a look at some of the other expectations for the miners later this week, it's still seeming like investors are quite bullish on the forecast and also what we'll ultimately see. So Harmony Gold and Sibanye are the two companies that we're looking ahead to. Harmony, the group share price, has more than gained 70% this year. Sibanye is an interesting story because they've been working on a number of projects and potentially we're going to get some insight into what they could potentially earn. But their expectation is 19 times higher headline earnings per share this year compared to June of 2024. And so most of the analysts that we're speaking to are just saying that this is really a boon considering the gold price and the expectations that we were seeing earlier in the year and really how they've panned out. And they believe that gold is going to continue increasing and potentially this is going to be a continued sustained rally for a number of these miners. The question, though, is will they be able to actually follow through with some of the output in South Africa?
Yeah, keeping a close eye on what's been happening with the price of spot gold. But let's flip over and talk about another sector entirely. Telcos, a whole bunch of earnings coming through this week. What are we looking out for there, Jen?
Well, it's a really fascinating story in South Africa because just recently we had Vodacom and Telkom get the approval to actually merge together. And just a few weeks ago, I was speaking to the CEO of MTN, who actually, even though Vodacom is a competitor to him, was saying that it's seeming like the regulatory environment is a bit more approving of some of these acquisitions. So when it comes to Blue Label, that's the company that we're paying very close attention to. They have this beleaguered part of the business called Cell C, and earlier this year the talk was potentially they're going to spin this off, and what would that look like for Cell C, and what would it look like for the telecom space in South Africa more broadly? Potentially we see the biggest telecom providers on the Johannesburg Stock Exchange, but really this is a story of the regulatory space. That's where investors are focused on, because then does this open the door to other companies to do the same?
Yeah. Jen, thank you so much. Jennifer Zavazaja, our chief Africa correspondent in London today. Now, coming up, Russian companies are recruiting young African women to fill labor shortages to help produce drones for Moscow's Ukraine war. More details on that story next. This is Bloomberg. Russian companies are widening their campaign to find young African women to help fill a labor shortage, heightening concern. Many are being deployed in Moscow's war efforts in Ukraine. Bloomberg's being told the South African government is now investigating this. Let's talk to our reporter, Anthony Squazan. This is quite a remarkable story. Maybe let's just start with how exactly these women are being recruited in the first place, Anthony.
Hi. Yes, it's largely an online program, but what has happened recently is that they've made a push into South Africa, which is a fellow BRICS member. That's what's new. And there's been a use of BRICS branded organizations. When I say BRICS branded, it's because they're not really officially connected to BRICS, but they do use the BRICS name. So they worked with something called the BRICS Women's Business Alliance, a South African chapter of that. The leaders of that organization flew to Russia, and then they signed an agreement to supply Beleaguered, which is this company, and another one, Etalon with 5,600 South African workers next year. In addition to that, they've used something called the BRICS Students Commission, which basically seems to be a South African organization alone, and used it to advertise the program on social media. And we also went to a school in Soweto where they had visited children, probably 16, 17 years old, and tried to get them to sign up to the program, get them to sign up to a WhatsApp group, and handing out free paraphernalia.
Wow. Okay. So they're providing these incentives, but the South African government has caught wind of what is going on. What exactly is the government looking to do?
Well, they haven't come out and said too much just yet, but they have said that they are investigating this. They've noted the push by this company, Alabuga, to recruit in South Africa and elsewhere. And from our reporting, we understand that they are quite concerned and that they may summon Russian diplomatic officials to explain themselves to the South African Foreign Ministry.
Yeah. Bloomberg reporter Anthony Squazine, thank you so much for bringing us this very important story on some of the recruitment policies that have been taking place in Africa to deploy women in the manufacturing of Russian military equipment. It's a big story there. All right, let's switch over and turn back to markets. The focus on the reaction to global markets to the Jackson Hole speech given by the Fed Chair Jay Powell, perceived to be quite dovish, laying the groundwork for a September cut, talking about some of the weakness that's popping up in the labor market. Today, though, S&P futures, NASDAQ not doing a whole lot. We're leaning sideways, though massive gains on Friday. Both of those indices up more than 1.5%. Also keep a close eye on Intel, with the U.S. government taking a almost 10% stake in that company. Stock was up around 6% on Friday in Friday's trade. And then later this week, we have NVIDIA earnings, PCE inflation to watch out for, and the 2-year, 5-year, 7-year auctions in the U.S. too. So it's still a very busy week, shaping up to be quite a busy week. And then, as you were speaking about earlier as well, very strong performance in Asian equities on back of some of the stimulus announced by some of those Chinese authorities on home buying curbs. But that is it for Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.